Hey, thanks a lot, first of all, to inviting me to this summit. I hope you can all hear me properly. Like I'm in a conference room right now. Okay, okay, great. So yeah, as you like mentioned, I am currently a software engineer at Google. Along with that, I am also founder of an initiative. We are calling it currently Engineer Trade, where our aim is basically to make every young Indian aware about different investment options based on their technical understanding of what their goals are and like all the technical understanding of how the stock market works and all of that. So yeah, that's the introduction of mine. Yeah.
All right. So Anshul, before we move further, tell me more about, how did the idea or, the conceptualization for engineer trade begin? And, what has been your investing and trading journey so far?
So the thing is, it's a very known fact that a very few Indians, I mean, I don't know the exact number, but it's around a single digit percent that very few Indians are aware about stock market, do actively invest in stock market. And the reason is that most of us don't have enough understanding about stock market or how it works. And I have heard a lot of times that people just follow the tips they get on social media
Mhm.
or their WhatsApp groups. So I just wanted to spread that awareness that okay, don't follow the tips on social media or WhatsApp and all of that. You can understand it very simply. Like there are a few charts, there are different types of charts which you can read and try to understand that okay, this is how the fundamentals of a company is, and you can follow those technical parameters to pursue your investment journey rather than being dependent on someone else. And now moving on to the second question that you talked about, like how has been my investment journey. So first of all, to put into perspective, like I am 23 years old. So I started my investment journey back when I was 21 when I joined Google. Like this, my first company. And from my first salary itself, I wanted to start my investment journey. So like I started it with a very safe option, mutual funds. It was a very bull market at that time. So I started it with mutual funds, which I felt was the safest option back then. If I talk about right now, my portfolio has like diversified 10 times more. I'm not talking about the profit or the growth. The investment
Mhm.
that I did, it has grown 10 times than what it was last year. And I have
Mhm.
diversified my portfolio into 10 different instruments, ranging from stocks to mutual funds to sovereign gold bonds to treasury bonds, and then real estate. Then there are different types of providential funds like employee providential fund, public providential
Mhm.
fund, then unit linked insurances and all of that. So I have experimented a lot with different types of instruments, and this has helped me get a better understanding of what my goals are, how my psychology is, like how do I become fidgety when the market is going down, how I respond to it, and what my risk tolerance actually is. So this has helped me a lot trying to diversify.
All right, that's some great piece of wisdom there, keeping your emotions out of the equation and diversification. All right. So for the beginners, because most of the audience that we have currently are, early career professionals who have just landed their first roles, or who are students who are who will be graduating out of university soon. So for the uninitiated, why is investing one of the keys to financial independence?
I mean, like obviously it's very great to have such a young audience. You people would also be figuring out. I am also still figuring out, but financial independence is one of the key milestone of like one of the key reason why we do any kind of work. Like we always have that retirement plan in our minds that we there would be one time in our life when we would just quit everything and want to enjoy the fruits of the hard work that we have done. So it's important to understand that whatever jobs we are doing right now, more or less the reason is to earn money. Obviously
Yeah.
some of us would be enjoying the work that we are doing, some of you wouldn't be enjoying as well. So the reason right now is more inclined toward earning more money, to get settled down, to buy the house that you always wanted to do, and more or less to kind of like appreciate the societal pressure that we have. So I mean, isn't it a beautiful thought that it's not just your hard work which can earn money? Your
Mhm.
money can also create more money on its own. Compounding is indeed the eighth wonder of the world, right?
Hmm.
Like, how long do you want to work? Obviously, it's not going to be forever. That's something that I'm presuming right now. So you still want to have a secure future. Let's say you get retired at the age of 40, 50, or 60, whatever your goals are. So you want to have a secure future even after that, and you want to ensure that there is an upward spiral with your money even when you retire. Like you don't want your investment portfolio or whatever your portfolio is to become stagnant after you retire. So being financially independent by investing in different instruments is important. If we look, like, investment is not a new term. Like, our ancestors also did investment. They did it in the form of real estate. Some of us have ancestral lands, we have ancestral homes, and a lot of us are still getting benefit of whatever our ancestors did invest at that time. So the options change. Like right now it's more equity oriented due to industrial and tech revolution. Perhaps tomorrow it will be crypto, I don't know. But the gist is the instruments may evolve with time, but the fact that investing leads to financial freedom is going to remain static. So that's the ultimate stuff, ultimate funda.
Absolutely. You touched upon a really great thing, that investing is not a new phenomena. Like it was done by our forefathers in terms of real estate or gold or whatnot. And currently it has become more equity oriented. So do you see, so my next question is in terms of risk tolerance. So currently, with the downturn of the crypto market, there has been a lot of apprehension amongst many new investors who have lost, a sizable amount of their income to the crypto downturns. And there has been a renewed interest in traditional forms of investment like fixed deposits and the sovereign gold bonds, etc. So, what's your take on risk tolerance, and how do you evaluate the risk appetite of all the investment instruments? What's your I would say algorithm about kind of making those decisions?
Right. This is a very, I mean, this is very interesting question, and this is the question that I would like to spend a lot of time on, because
Mhm.
at the present moment maybe we would not appreciate risk tolerance a lot, or perhaps asset allocation as well, because we don't have a lot of responsibilities on our head, because we are just getting started with our journey. Perhaps our parents are still working and they are about to plan their retirement, and we have a long way to go with our family, with our children, and all of that. So it's really important to understand what risk tolerance is, what different forms of asset allocation can be. So I think I will spend a little bit of time explaining what risk tolerance is exactly and what asset allocation means in this particular context. Since you touched upon the fact that, okay, crypto market is down, I want to highlight this, and this is just my personal opinion. I have always been averse to cryptocurrency. I will touch upon this like further in the session, why and what and all of those stuff, but it's just my personal opinion. It is definitely biased, so don't take it on my words. Do your own study, do your own analysis, and then make an informed decision based upon that. So moving on to what risk tolerance is. To explain it in very simple terms, risk tolerance means how much can you afford to lose. Okay, how much can I for example, like when COVID started in April 2020, our stock markets, not just India's, all around the world, all the indices, they shut down to almost 50%. Some went down to 60%, 70% as well. Some countries even become bankrupt. Okay, I'm not going to name those countries, but a lot of us suffered in ways we had not comprehended before. We never knew such a disaster could ever happen, right? And this is the reason why we need to understand risk tolerance. Okay, so let me just give you an example. All right, let's say I am planning for my child's future. Okay, I'm not married, I'm not even planning to have kids or anything like that, but let's just give an example that I'm planning for my child's education after 25 years. Okay, the my kid would be like possibly wanting to go into college, I don't know, but I'm starting it 25 years in advance. So even if it reduced by 50%, I don't think it would have affected me a lot, because if I look at the trend of all the indices, like the recession periods or the bearish markets, they are mostly 2 to 3 years, like they are not longer than that. So if I look at a longer term, like 20 years or 15 years as well, the markets have overall grown 10%, 12%, or even 15% in some situations. So it's not much of an issue if I had to lose my corpus by 50% at this particular stage. All right. So now let's imagine that like I was married and my child was supposed to to go into college in 2020 itself. All right. So now, if I was investing aggressively and the majority of my allocation was towards equity and stock market, then whatever portfolio I had built in those previous 25 years, all of that would have been reduced to 50%. So I don't think it's a good enough excuse for my kid that, okay, please drop out of the college and become the next Mark Zuckerberg and create your own startup, because I don't have the money. I was immature enough to invest aggressively into equity and all of that. And that's the reason why I lost 50% of the corpus. So that's not an excuse that you want to give, right? So that's one situation where I am explaining how risk tolerance differs with what stage you are in, where you are standing in terms of your goal. Am I standing at the beginning of my goal right now? Am I in the middle of my goal, or am I standing at the tail end of my goal where I am supposed to bear the fruits of whatever investment I did in last few years? Okay, so risk tolerance matters with that timeline particularly. It's important to understand where you stand in that timeline. Okay, now explaining what asset allocation means. So there are different instruments of asset allocations, like there are different instruments in which you can invest. Real estate is one of the traditional ways. Then comes equity. In equity also, like there are different forms of small cap or large cap or blue chip stocks in which you can invest. There are mutual fund options which are safe, some of which are very aggressive and risk averse. So those are the options. And then there are more friendly options like corporate bonds or sovereign gold bonds or treasury bills and so on. So like you mentioned that people are moving towards more conventional forms like fixed deposits and sovereign gold bonds and all of that. So I also started investing in fixed deposits and treasury bills and all of that just a few months back. So I can completely understand, like I now understand my risk tolerance level. I don't want to look at my stock market portfolio and see it in red all the time. So I am trying to diversify my asset allocation to more risk averse instruments like fixed deposits, or possibly trying to increase my investment in providential funds which have a fixed return, like ppf has 8.1 sorry epf has 8.1% returns right now in India, and ppf has almost 7.1 around. So I think I am moving more towards a balanced portfolio, which before COVID I think it was mostly oriented towards, like aggressively towards stock market and all of that. So the question is, can you afford to lose 50% of your corpus in an year or not? So that defines your risk tolerance levels. And moving on to what my funda of, or my algorithm of investment is, right? So I feel that when you are in the beginning of your investment journey or any goal that you have planned, it's fine to be more aggressive. It's okay to be more like risk friendly, because even if you lose 50% of your corpus in 1 or 2 years, it's slowly going to go back to its normal levels after 15-20 years. So that's completely all right. So initially 75% aggressive allocation, remaining 25% can be fixed deposits or gold bonds or corporate bonds or even government bonds. It's completely up to your choice. Study the different features because some of them have lock-in periods involved as well. For example, if you invest in some of the debt funds, they have 3-year lock-in period. So you need to understand what your goals are. Do you want to liquid, or do you want to encash your investment within 1 year if there is some, like say there is some family emergency or there is some medical emergency? So you need to be aware about all of those situations, all of those features or offerings that are provided to you by this investment instruments, and then only invest into them, right? So 75% aggressive, 25% risk averse instruments. And then as you move closer towards your goal, let's say like 2020 was my like when my child was going to get into college. So by the time it was 2015, I would slowly try to move from the aggressive solutions towards the more risk friendly solutions or risk averse solutions, you know. So by the time I was going to reach 2020, all of my portfolio or majority of my portfolio, almost 90% of them, should be in terms of corporate bonds or treasury bills or something which I can liquidify in 1 year or so. And it makes sure that my corpus doesn't fall down by 50% if an unprecedented situation like COVID happened again. So that's what I usually suggest people, to make sure that they smoothen out the transition from aggressive to more friendly and happier solution as you move closer towards the move closer towards the end of your goal.
That's so great. And I loved, the tips that you gave that, there are so many factors that go into kind of finally computing your risk appetite. The current position of where you're at with respect to your goal. And I love the analogy, this child marriage analogy that you provided. So I love that.
I
So
want to
moving
add one more
forward,
point if you don't mind.
absolutely.
Yeah, so I talked about the goals, I talked about where you stand in the goal, but then there are different types of goals as well. For example, I talked about child's education. Some people have a goal to build their house after few, like 10-15 years. Some people have a goal for their marriage or perhaps to buy a car as well. So it's important to understand that some of these goals are time strict. Okay, you
Mhm.
cannot postpone your child's education after the child is born, obviously, but you can postpone when you build your house or when you buy your car. So it's
Mhm.
important to understand that the asset allocation will vary from goal to goal as well, and not just where you stand in a particular goal. Okay,
Yeah.
you can postpone some things, but you can't postpone some other things. So you need to be wary of what your goals are exactly, and not just where you stand in your goal.
Yeah, absolutely. Love that. Love that final tip. All right. So moving on, I'd love to talk about company shares and employee stock options. So how can tech professionals best leverage their company shares or ESOPs as a part of their investment portfolio? What's your take on that?
Right. So if I tell you my situation right now, I never considered my company shares in my portfolio because that is something static and I don't look a lot at what my company shares are. But I think, like, after reading the book by Warren Buffett, I think I will really consider how I should leverage my company shares. I did some study around it, and I found out that, like, leveraging the company shares is a very subjective question. It will vary from company to company. For example, being in a company like Google, Microsoft, Apple, or even Amazon, and like some other top tech companies which are like blue chip, which have blue chip shares, you know the reaction or the behavior which you will have towards those shares or those portfolio is going to be completely different when compared to the ESOPs which you might get if you are a part of a startup,
Hmm.
right? So, for example, I work at Google. If I look at the history of my company or even like Microsoft, Apple, they have given a CAGR of greater than 10% for the last 5 to 10 years, which is very healthy. And this is what we call, like, this is what we define the blue chip stocks as. So I definitely would want to remain invested in them because they have a history of performing well, even in adverse situations, like the Lehman scandal, which happened in 2008 in the US, or the COVID crisis that happened right now. These stocks have emerged out of them and are performing well even now. So I
Hmm.
would definitely want to remain invested in them as much as I want to, unless I want to use that money, pull out the money for some big expense, like planning a house or planning a world tour or something which requires a lot of money. All right. So for such blue chip stocks, keep remain invested. That was my mantra till now. So that was my mantra till now. And let's say you are a part of a startup which provides you ESOP. So
Hmm.
there is a fair chance that your company might get listed sometime down the future and you might just become rich overnight. So that had happened with a lot of my friends, that they become like super rich overnight, like their stocks grew 100% within a few months. And then after a few months, when I checked their stocks listed on the New York Stock Exchange, they dropped down 80% as well. So
Hmm.
that's the volatility that you need to understand that these startups may have. Okay, I'm not generalizing this fact. Some of the startups are performing amazingly well. Some of them are really volatile in their initial period. Like if I talk about Nika or Paytm and all of the stocks, which Zomato as well, they were listed recently during this COVID times, and we were very, very bullish on those stocks. But those stocks did drop by 50%, 60% as well. So it can
Yeah.
make you rich overnight, and it can also reduce your portfolio or the company shares by 80, 90% as well, if we are not alert enough about how the stock may behave or is going to behave in future. So if there is volatility, it is advisable to cash out and invest in more blue chip equity options. So my from whatever stocks that I get, okay, whatever my Google stocks are right now, I understand that they are going to overweigh your investment portfolio. Till now, I didn't consider my Google stocks into my portfolio, but when I adjusted my Google stocks into my portfolio as well, I found out that more than 50% of my portfolio is just Google stocks. Okay, so based upon my learnings from what Warren Buffett suggested, you should not put all your eggs in one basket. Okay, it's definitely not one basket, because remaining 50% of my portfolio is different instruments, but yet 50% is a lot. And what Warren Buffett suggests is that your company shares should be around 10 to 15% if you are very confident where your company is headed towards. Okay, if you're not confident, if you're just after the startup money that these startups are offering right now, it's always advisable to cash out the stocks and invest them into more blue chip options. So
That, yeah, go on.
like, even I believe, even with the Google stocks, like I love Google a lot. I am really bullish about where Google is heading right now, but still I would suggest that every 5 years I should cash out some of my Google stocks and perhaps invest them in other international blue chip options like Apple, Microsoft, and so on. And I mean, just imagine, okay, I'm giving a hypothetical situation. What if Google tumbles? Okay, it's not going to tumble. That's not the plan, obviously. But just imagine a hypothetical situation. Your company tumbles. Okay, you don't want to lose your investment. And perhaps there's also possibility that when your company tumbles, you might lose your job as well. Okay, that's also a possible option. So you don't want your company's financial issues to reflect your personal financial issues. So it's always advisable to diversify as much as you can. That's what my mentor also does. That's what my manager also does. He also cashes it out after every few years and puts them into different other blue chip options like Microsoft, Amazon, Facebook, and so on. So that's what my suggestion to any investor or any tech person would be.
That's so great. And talking about diversification, uh, how does, like, for those who may not have easy access to foreign currency or investment accounts that allow trading on the world's main exchanges, how does blockchain offer a comparable alternative for getting your hands wet in trading across the exchanges of the world? So tell us more about that.
So this is where my biased opinion will come into play, because I am personally not a very big fan of crypto. I will tell you the reason why in this answer as well. Okay, I believe in diversifying the portfolio. That's one thing for sure. But now let's say you are talking about foreign stock options. Okay, let's consider the different options apart from blockchain and cryptocurrency as well. So at present, if we are talking about India, then you can invest in those foreign stock options through third party applications like IND Money as well. I don't use it myself. I use only Zerodha and don't like invest in the foreign stocks directly. The reason being, I don't like using multiple applications to trade. It makes investment and keeping track of all of the things difficult. So I invest in them through mutual funds. A lot of fund management companies provide asset allocation into international funds and international stocks as well. For example, I invest in Aditya Birla International Equity, ICICI Prudential US Blue Chip Equities Mutual Fund. All of them have diversified into these tech companies like Google, Amazon, Microsoft, Snapdeal, Snapchat, and all of those amazing companies who have performed well over the time. So I usually prefer investing in them through mutual funds, because it also tries to diversify my portfolio rather than going all in into some of the stocks, particularly or individually. So these are the options that I follow to get my hands wet into other stock exchanges. Now coming over to the question about blockchain and cryptocurrency. I know it has made some people super rich. Okay, I'm not ignoring that fact. Some people have become super rich investing in cryptocurrency, but I still have my own set of reasons why not to invest in the same. First, and the very important reason is I am not sure what fundamentals do these cryptocurrencies follow. For example, like stocks are backed by company performances. If we talk about HDFC or Reliance or Titan or Bajaj Finance, all of these amazing companies which have performed well over a lot of years, these are these the performance of the stocks is backed by how the company is performing and its reputation. Okay, you can back your decisions if you want to invest in them or not based on some technical parameters. But I feel cryptocurrency is still in a very premature stage and very speculative. Like
Hmm.
one day Elon Musk will tweet something about cryptocurrency and doggy coin will go haywire and crazy. The other day Indian government will bring in some regulation, and you know that cryptocurrency is tasting dust the next day. So
Hmm.
honestly, I don't think that comparing crypto options with equity is a fair thing. Both of them have their own upsides and downsides, and we cannot compare them, to be honest. Though I would suggest if you want to play around with some decentralized options, you can surely allocate less than 10% of your investment funds here. And that too, I feel it's a bit too much considering we don't know at all how and why the cryptocurrencies will perform. So I
Yeah.
know some people here would be like, dude, just wait, Bitcoin will go up. Yes, it will go up. I know everything that falls down will go up someday. But when will it go up? How will it go up and why will it go up? You and me, none of us have any idea about it, right? So this is not a snakes and ladders game where you can just keep rolling your dice forever. You don't even know where the snakes are and where the ladders are. So
Hmm.
my personal opinion is to avoid these options at the present time, because there are some regulations coming in, 30% taxes and 10% TDS, 1% TDS and whatnot. So let's just wait till the things become normal, till we understand entirely about how we can proceed and invest into blockchain options and cryptocurrencies. I know I can be wrong, but this is just my opinion.
That's so great. Since we are nearing to the deadline and our end of the session, I'd love to know, can you maybe suggest some resources for all of our viewers, to get started on the investing journey or the trading journey?
So, first thing first, if you don't have a PAN card created yet, obviously, if you're working in some company, you would have a PAN card created. If you are in college and you are just waiting for like getting a job and then creating a PAN card, please create a PAN card as soon as you touch 18. Next thing, as soon as you touch 18, please create a demat account. Not necessarily that you start investing directly when you are 18, at least start creating a demat account so that you have a platform ready. I
Hmm.
I'm not promoting, okay, here, but I personally find Zerodha's user interface very friendly. So I would recommend users to use that. It's completely up to you. If you find some other platform friendly. Now, coming on to the resources to start investing. Okay. So self-learning is really important. Don't just go by the advice of your friend or your cousin. All right. So this is where Google Varsity is one application which I have used a lot to understand how trading happens. Not just the conventional stock options that we have, mutual fund and all of them, but also futures and options is something I am currently learning how it behaves and what are my different options. So Google Varsity and Investopedia, those are the two resources which I personally have used in my life, in my investment journey, and it has helped me understand a lot.
Thank you so much, Anshul, for dropping these wonderful nuggets of wisdom. I'm sure all of our audience will have a lot of takeaways to, go with and action them after this session. And I really love some of the takeaways that you shared and with examples. So thank you so much, and we look forward to hosting you in the future.